Good evening, everyone, and a warm welcome to AU Small Finance Bank's earnings calls for the third quarter of FY24. We thank you all for joining the call on a eve of the Republic Day. And the format for today's call will be similar to last few quarters, where we will start with the opening remarks from the senior management of the bank for the first 20-25 minutes of the call. And we'll then follow that with a 30-35 minutes of question and answer session from all the participating analysts and investors. To start the call, we'll have our founder, MD and CEO, Mr. Sanjay Agarwal, share his thoughts on third quarter FY24 overall performance of the bank. He'll be followed by our Executive Director, Mr. Uttam Tibrewal, who will also share his thoughts on the business highlights for the quarter. And besides them, we also have some senior members of the management on the call today to answer any questions that you may have. For the benefit of everyone, and so that we can all have a active participation, I'll request everyone to kindly restrict the number of questions per participant to 2 and join back in the queue in case you have additional questions. With that, I'll now request our founder, MD and CEO, Mr. Sanjay Agarwal, to start today's call by sharing his thoughts on the bank's performance and his strategic outlook for the bank.
Thank you, Prince. Good evening and namaskar to everyone. I'm pleased to speak with you on the eve of 75th anniversary of our National Republic Day and want to express my sincere gratitude to all of you for your presence today. Before I share my thoughts on the bank performance and strategic outlook, I would like to take the opportunity to thank each one of you for your unwavering support and confidence in our bank, which motivates us to continue executing every day. As you know, building a truly bank is so difficult. I'm sure by now all of you have heard everything about the global macroeconomy on multiple calls, so I will not go much into the details. However, I will share my perspective on the whole India euphoria and the opportunity that it presents, and then why I think this era belongs to India. Our Honorable Prime Minister vision of India at 2047, by when we complete 100 years of independence and aspire to be Viksit Bharat, is truly inspiring for an entrepreneur like myself, and the opportunity and the scope for execution it provides to an institution like AU. I am really excited about this period of growth as it coincides with our own philosophy of building AU forever. The first phase of our forever journey, that is AU at 2027, is the foundational period of first 10 years of our banking journey. Post that, I strongly believe that AU will be a significant contributor and beneficiary of this India story. Coming back to India story, there are many trends that are available, but in my opinion, 5 significant trends which we are witnessing in the Indian economy and the social environment have the potential to have a fundamental impact on our journey. First, the recent structural and regulatory changes and growing adherence to the rule of the law will have long-lasting impact on the overall governance and transparency in this country. Second, as the world becomes more digital, the tech acumen and knowledge that we possess as Indians has the potential to change the Indian democracy in the next 25 years. Third, the entire MSME space will create their own niche, and we are already seeing some initial trends of how the formalization of MSME is helping entrepreneurship. Fourth, our capital market is poised for long-term growth, and with a wider participation, financial products are new high, but can innovate a lot more on the back of penetration. Fifth and most importantly, India is a vibrant democracy, and the way we are handling ourselves and settling our issues one at a time is commendable, bringing harmony and acceptance at all levels. As India redefines himself and becomes more purposeful and get characterized for its democracy, knowledge, execution, and consumerism, I'm very confident that AU will be one of the institutions that will play a lead role in this journey. The first 7 years of banking journey has remained absolutely on track and completely seamless, guided by strong regulatory framework which we followed in letter and spirit. During these foundational years, we have built a safe and sound bank, delivered good results consistently, built robust senior management team, and have protected interests of every stakeholder, be it regulator, customer, employee, shareholder, or society at large. Our focus has been steadfast on every parameter needed to build a sustainable and complete bank, be it deposit franchise, retail and commercial banking, digital banking, transitional banking, payment infrastructure, tech architecture, leadership development, compliance and governance, asset quality, customer focus, cybersecurity, or even ESG. Every aspect has been covered. With operationalization of the recently received AD1 category license and on completion of the proposed merger with Fincare, the bank will be in position to offer all product to all category of customers, be it domestic or cross-border, or be it bottom of the pyramid customer or ultra HNI. You know, against this backdrop, I would like to share my reflection on our performance in the third quarter and certain operating highlights of the bank. Our Q3 results remain in line with the anticipated outcomes, driven by the persistent dedication of our team. This quarter makes a significant milestone for your bank, with our balance sheets crossing 1 lakh crore. Our deposit registered at 31% year-on-year growth, crossing 80,000 crore mark. We have also used securitization on a strategic tool to diversify our source of funds and use our capital efficiently. Gross of securitization, our loan book has also crossed the milestone of 75,000 crore mark. As you would have recollect, about 6-7 quarters back, we had pivoted our entire strategy to be a deposit-led assets franchise, something which industry has started talking about now. We have been good enough in reading the evolving landscape and started prioritizing sustenance of the business model, making it more acceptable to all stakeholders. Over the last 24 months, we have worked on every aspect that the industry is currently debating, be it reducing the CD ratio, calibrating our asset growth to the follow deposits, shading wholesale deposits, avoiding going aggressive on unsecured loans, not partnering with fintechs solely for origination, settling strong governance standards, or focusing on farmer financing and financial inclusion. The current quarter saw our deposit book grow by 6% compared to Q2, and CASA deposit increased by 3% quarter on quarter. More importantly, our saving account balance grew by 8%, whereas our retail term deposits grew by 5% during last quarter. Our CASA ratio is at 33%. CASA plus retail term deposit is at 64% of our total deposits. A consistent effort is being directed towards reinforcing CASA and retail term deposits, notably through enhancement in our product offering, services, and brand, steering away from the sole dependence on interest rates. But let me also admit that our current account franchise built out has not been extent what we would have liked, partly because limitation of the platform, partly because of excessive competition in that zone. But now we are working hard to relook at our strategy around the same and expect that operationalization of AD1 and transition banking will support our CASA strategy. Elevated interest rate continues to be a market variable driven by tight liquidity and the regulatory requirement of controlling inflation. This is impacting the overall industry, and thus cost of deposits remains a challenge. It has led to a 78 basis point increase in cost of funds in the first 9 months and 20 basis points in the current quarter. At the same time, we operate a high-yield customer segment, and thus there are limitations to increasing the disbursement yield without compromising on the asset quality. We have still managed to improve our disbursement yield by 38 basis points on YTD basis and continue looking for more such opportunities. This has resulted in our margin contraction by 6 basis points, with an overall net interest margin at 5.5 for the quarter and 5.6 for the last 9 months of this year. As observed in past cycles, the presence of fixed retail book and market segment will be advantageous when interest rates undergo a reversal. Our loan portfolio demonstrated robust growth, increasing by 6% on quarter-to-quarter basis. This growth was sustained by surplus liquidity buffers and notable demand for credit. Our emphasis on asset is centered on prioritizing yield and adherence to our underwriting filters. Uttam will provide more insight on this. Gross NPA increased by 7 basis points quarter-to-quarter, reach 1.98. This marginal GNPA increase in the quarter can be attributed to low base effect, as we have securitized approx 2,700 crore of loan assets in this quarter. On the overall portfolio, gross of securitization, our GNPA increased marginally by 3 basis points to 1.3 from 1.8 in the previous quarter. Slippages during quarter was around 403 crore against 350 crores in quarter 2 FY24. Credit cost net of the recovery for the quarter normalized to 62 bips, with an 18 bips contribution coming from credit card book. As the credit card book attains a size and gets seasoned, the credit cost for the same is also getting normalized and coming in line with the industry average. Overall, asset quality remains within our range as we are not seeing any sign of stress build up or any specific pockets of warning signals. However, some traditional impact was seen during the quarter in enforcement of collaterals with state elections immediately following the festive season in two of our biggest markets, Rajasthan and MP. This led to a lower resolutions and recoveries during the quarter. Cost to income ratio is within our guided range. Our focus on investment to build a full stack bank like credit card, digital initiatives, ADML license, and transition banking, wealth management, brand build out, and upgrading our tech capabilities will remain our key priority, and we'll keep investing in them. Merger of Fincare, which is on track, and I'm delighted to inform you that post securing the shareholder approval, we have now received CCI approval earlier this week. We now await one final approval from RBI. This merger will provide us with a wider distribution of and higher margin products and opportunity to diversify assets, customer base, and geographic presence. In terms of future outlook, we are focusing on our tech and innovation. We are continuously enhancing our tech ecosystem and digital properties, migrating our tech to cloud, expanding our data centers, building our data warehouse, and developing analytical workbench remain some key projects that are being progressed. I also believe that our focus on tech is also giving us desired result and creating our own space in this competitive zone. Our pace of customer acquisition has got a significant boost due to our digital product with the possibility to acquire more than 1 million customers next year. Our next focus area in this tech segment is AI, which we are excited about and which I think is critical for our next phase of growth. HR and people practice remain key focus area for me personally, as I feel banking is a people's business. I am fortunate that entire senior team has a common vision and is quite stitched and aligned to the overall purpose. In these 7 years, we put our best foot forward and already working on many initiatives to nurture our talent with partners like Conferry and Avon, with a keen focus on their learning, training, motivation, retention, career path, succession planning, and other such areas. We are working to build a pool of talent to take forward our forever journey and create a human capital for the bank for generations. We have been focused a lot on efficiency and productivity of our people and reorganize the business groups under 5 businesses with leadership aligned at every level. Similar nature of businesses were brought under one umbrella to align them with a single objective and avoid any transition gap. All this, along with various automation projects, has resulted in a significant productivity lift for our on-ground sales, credit, and operation team. This has resulted in a relatively stable manpower over the last 8 quarters, despite the business growing at 25% CAGR on both advances and deposits. In the end, I can assure you that we are committed to build one of the most trusted and finest banking institutions in this country. We aspire to be a full-service bank for our customers and need to manage multiple stakeholders. Sometimes that is own cost, but it brings sustainability to the franchise. And while we are building for the future, we are also delivering consistent results while also continuing to lead by example as the largest SFB. On our various investment avenues, shall start yielding profitably from FY26 and will help us unlock operating leverage. Our size and scale will give us an advantage beyond 2027, and we are strategically preparing ourselves for that phase. In closing, I stand before you today not only as a CEO, but as a custodian of your trust. I assure you that we'll continue to push the boundaries of what is possible to create sustainable value and to deliver on our promises. Our path may be challenging, but I am confident that your unwavering support we will triumph. Thank you once again for joining us. Over to Uttam for the further operational highlights. Thank you so much.
Thank you, Sanjay. Namaskar and good evening, everyone. Wish you an abundance of health and happiness, and my wishes for the 75th Republic Day of our great nation. I will now share an update on the operating highlights of our key businesses for the third quarter of FY23-24. India's story has remained strong despite global headwinds, and Indian economy continues to grow with all leading indicators being in the positive range. During the third quarter, the festive season provided momentum to consumption and the overall demand remained robust across segments. However, tight liquidity and global risk, including geopolitics, continue to pose threats to trade flows and commodity prices and warrant caution. We continue to remain watchful and agile as we move forward. Let me start with an update first on our digital banking business. As a tech-led bank, our core focus is to identify digitally native customers, offer them differentiated products, and engage them using state-of-the-art digital application and service platform, providing them convenience and branch-like experience digitally, thus providing them value along their entire life cycle with us. The collective deposit balance of the video banking portfolio now exceeds 1,500 crores with over 4.5 lakhs customers. Our digital savings acquisition saw an uptick of 30% quarter-on-quarter. Additionally, we had introduced digital current account offerings in the previous quarter, and I'm pleased to report that we have scaled to over 3,500 accounts in this quarter. We have also now added corporate salary accounts to the video banking platform in this quarter. With the help of our all-inclusive video banking solutions available 24/7, we are now serving over 1,000 customers every day with 400 plus services. I'm also happy to inform that we have crossed 26 lakhs registered users on our super app AU0101, registering a 11% quarter-on-quarter increase with monthly active users growing by 8% to over 14 lakhs. Moving to merchant acquiring business, we have added 2,200 point of sale and witnessed activation rate of 50% in this quarter. As the overall transaction value grew 17% quarter-on-quarter to 575 crores, average ticket size also grew by 15% and contributed to 37 lakhs transactions in Q3. Updating on our credit card business, during the quarter, we launched our first ever co-branded card with a leading travel partner, Ixigo, allowing us access to more than 15 crore users, largely based in their Tier 2 and Tier 3 locations. Overall, our credit card business at 8.3 lakh cards has not only helped in doing cross-sell to our existing customers, but has also become a robust channel for customer acquisition for the bank. This festival season, we continued with our annual shopping bonanza under the brand of Heart to Cart, which was live across all platforms, including Amazon Great India Festival with total spends of over 2,200 crores. Now moving on to our liability franchise. Overall deposits crossed 80,000 crores in this quarter with 6% quarter-on-quarter growth. We continue to focus on building a retail and granular deposit franchise through high-quality customer acquisition. During Q3, our banking programs AU Ivory, AU Royal, AU Platinum made up 44% of the total customers. Similarly, the share of higher variant current account was 35% of total acquisition in Q3 FY24. Our PPC currently stands at 1.7 and 2 for savings and current account respectively, with 58% savings and 68% current account customers being transacting with us on a monthly basis, indicating a healthy customer engagement. Our drive towards customer acquisition and engagement were complemented by the second season of our Badlaav Humse Hai campaign, with Kiara Advani as brand ambassador. Our latest campaign, Soch Badlo or Bank Bhi, reached 10 crore people through TV, print, radio, cinema, and digital media. As per Kantar Brand Track Survey, the campaign achieved 80% recall among our targeted audience and, importantly, a 50% lift in brand consideration. Our Green Deposit program, Planet First, launched in Q2, has received strong initial support from customers, raising 200 crores deposits till now. We are deploying this money in green projects like solar power, electric mobility solutions, etc., making a humble beginning in contributing to India's net zero mission. Last quarter, we created Swadesh Banking Group to strengthen our banking services in India's Bharat. By unifying rural branches, BOBCs, financial and digital inclusion, and small and marginal farmer lending under one umbrella. This leads to greater collaboration and innovation to design products and services tailored to the unique needs of this niche segment. In this quarter, we launched three differentiated products for this segment, namely Swadesh Saving Accounts, Swadesh Current Accounts, and Kisan Savings Accounts. Let me touch upon our cross-sell initiatives. Cross-sell of assets to branch banking customers was 890 crores during Q3, as against 598 crores in Q2, showing a growth of 49% on sequential basis. In insurance, our total distribution increased by 23% sequentially, with total business growing from 158 crores in Q2 to 194 crores during Q3. In our wealth business, our recently added referral offerings like PMS strategies and differentiated AIFs allow us to offer a complete basket of products and helps us to serve our high net worth customers better. During Q3, our investment AUM has reached to 521 crores across 1.6 lakh customers, registering an AUM growth of 50% quarter on quarter. Moving on to our asset franchise, we maintain sustained disbursements across our retail product segments, which are Wheels, micro business loans, and housing loans. Our total gross loan portfolio, including securitization, has crossed 76,000 crores, and our flagship products, Wheels and MBL, have crossed the significant milestones of 27,000 crores and 20,900 crores, respectively. Let's start with our Wheels business. This quarter, the vehicle industry sold 70 lakhs units, showing 10% growth year-on-year and 29% growth quarter-on-quarter. Strong quarterly growth was visible in the two-wheeler and the passenger vehicle segment, with 37% and 10% growth, respectively. In Wheels business, this quarter, we have disbursed around 4,500 crores against 3,600 crores in Q2 FY24, registering a 23% growth quarter-on-quarter at an IRR of 14.57%. Our average ticket size remained around rupees 5.3 lakh on disbursements. As on 31st December 2023, the total loan portfolio of Wheels stood at 27,000 crores. With the increase in seasoning of book, GNPA is maintained at 2.6%. Further, all disbursements for auto loans and two-wheelers were made through the Wheels One app, a digitized process based on Salesforce platform and FICO BRE. Moving on to our micro business loans, as on 31st December 23, our loan portfolio stands at 20,900 crores with a portfolio weighted IRR of 14.80% and the GNPA of 3.1%. During Q3, we disbursed 1,600 crores and a total of 4,400 crores in 9 months period between April to December, with an average ticket size of 12.6 lakhs. Now let's look at our housing finance business. Loan portfolio of our home loan business at the end of Q3 reached to 5,400 crores with quarter-on-quarter growth of 8%. The average ticket size on this book is 12 lakhs at an yield of 11.57% and gross NPA of 0.6%. Our total disbursements in Q3 stands at 579 crores with YTD disbursements of 1,700 crores. Shifting to our commercial banking, the commercial banking portfolio grew by 47% on year-on-year basis to reach 16,386 crores as against 11,179 crores as on Q3 FY23. Commercial banking did fund-based disbursements volume of 3,000 crores in Q3 FY24, of which business banking and agri-banking accounted for 61% of business. GNPA for commercial banking stands at 0.40%. Business banking active limit stands at 13,500 crores and the gross advances are 6,800 crores, showing year-on-year growth of 56% and sequential growth of 11%. Business banking recorded a disbursement of 1,000 crores in Q3 and GNPA stands at 0.52%. The agri-banking business has now reached 5,200 crores with GNPA of 0.30%. This quarter, we saw fund-based disbursement of 783 crores with a growth of 23% quarter-on-quarter. Under our FPO financing program, we have now supported funding needs of more than 1.5 lakh farmers via 406 FPOs, including 130 new FPOs added during this quarter. Additionally, In the current quarter, we have financed 17 new renewable energy products to farmers under the Pradhan Mantri Kusum Yojana, taking the total renewable energy financing for agriculture to 177 crores as on December 31st. Summing up, the liquidity deficiency and competition among banks has pushed deposit rates further up. We continue to closely monitor the competitive landscape and execute our strategy of building a retail, granular, sustainable deposit franchise. We will continue to consolidate and enhance our inclusive banking efforts and augur digital inclusion. We believe that the unique positioning of the bank to identify wide spaces across geographies and customer segments and execute on those opportunities will help us continue to grow sustainably. Furthermore, concentrated efforts are being made to enhance the share of wallet through cross-selling of current accounts, saving accounts, QR, personal loans, and credit cards to new-to-bank customers and existing-to-bank customers, fostering stickiness. We will continue to exercise a strong level of prudence as we plan for the coming quarters with uncertainty around interest rates and inflation. The outlined strategic initiatives collectively position us for sustained growth and amplified market presence. I'm eager to share many more positive updates with you in the coming quarters. Till then, stay safe, stay healthy. Thank you. Over to you, Prince, to take it forward.
Thank you, Uttam sir, and thank you, Sanjay ji. Sagar, we can now open the floor for questions.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets only while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhavesh Ratilal Kanani from Ask Investment Managers. Please go ahead.
Thank you for taking my question. This one is on the disclosures on the 31st slide, provisioning summary. Basis the disclosure of net credit cost and excluding credit card credit cost, those numbers essentially imply that probably our credit card business annualized credit cost is around 6.5%. Wanted to verify that, and if that is the case, where do we see it stabilizing? Is 6.5 a level which is comfortable to us, and any directional outlook you want to give?
So, Bhavesh, before Mayank, can answer the details around that, let me just first the number is confirmed. You're absolutely right that broadly the credit cost on the credit card book in this quarter is in the range that you mentioned. You'll appreciate that the book is getting built out, and it's very early days, and credit card is known to be a high credit cost business, but a highly profitable business as well. Now, while we have started seeing the credit cost as the book is getting some sort of a maturity and size, you just understand that it's just less than 3 years since we have started operations. The profitability have also in some ways started showing up, but of course we are not yet at a level where we can, say that the ROA of the book is more than the credit cost. But Mayank, you want to add anything in terms of the future outlook?
So, good evening, Bhavesh. Adding to what Prince said, yes, the credit cost is around this percentage only, which you mentioned. But since we are in the third year only, and we could see the trends coming across. So trends are more or less stating that they are getting stabilized and on the reducing. So we will remain under this trajectory only, and this is what the nearing to the industry average also. So this is on the credit cost, and future aspect is we are building our term book, and we are confident that we will build that to some certain more extent in the coming year. So that will also support us, and in the fourth year we will be able to give more guidance on the profitability piece.
Okay, wonderful. Thanks, Mayank, for that. The second was on the industry level scenario on the term deposit and liquidity as well as deposit mobilization in general. If Sanjay sir could share his thoughts on these aspects.
Oh yeah, so thank you, Bhavesh. So I think I commented on my narrative is this, that this is a very tough environment. Liquidity is a challenge, but overall we have performed very well. We have done 80,000 crore of deposit last quarter. Our CASA is around 33%. Our retail plus CASA is around 64%. Cost, of course, is not actually in our hand because market is too competitive. Every bank is looking to build their own deposit franchise. So there is a war on the rate, right? But we have managed it through, raising CASA, retail deposit, wholesale deposits, also have done securitization. Overall, we remain in absolute control of things, barring the cost of money. And, it's not easy to build 80,000 crore of deposits on a SFB platform, but team has done phenomenally well in last 7 years to be at this stage. We have built not many hooks, like you're talking about credit card. Credit card in last 2 years has given us tremendous visibility, a tremendous recall values, tremendous brand build up, right? So I think we are doing around wealth, we are doing around credit card, we are doing around our whole payment systems, app, so overall, the purpose of entire bank is to build a deposit, right? And so we are really focused to build a deposit franchise first, and then of course an asset led around it, and then we have done it, I'm saying this from last maybe now good 2 years that, we want to be a deposit led asset franchise. And you would have seen our CD ratio, which is now touching even below 85%, which is one of the best in the industry. So, of course, I'm very happy the way we are building up. Of course, another 3 years more, where we want to be known as retail bank of this country. So, absolutely on course for that.
Just one clarification. When we talk about intensity of competition, do you see risk of hikes in term deposits in the industry?
You're already seeing that, right? You're already seeing that, would have read or would have attended every call, so every CEO is looking to build more deposit-led strategy now. So, I won't say that I would be surprised that, if there would be a hike in rate from here onward in terms of competitiveness around bank only. But your bank is in very, I would say, in a very safe zone because our CD ratio is 83, 84. Our CASA is around 33. We have already getting our. We are not be there on the market for every deal now, right? So we know what to take, what not to take. And Yogesh, you want to add something? Okay.
So, Bhavesh, on liquidity side also we are pretty comfortable. We have LCR of 128% as on December. Additionally, we have very high quality non-SLR liquid book, which is also available in range of 4 to 5,000 crore. So in liquidity also as a bank, we feel so we have that opportunity where we can leave some of high cost deposits actually.
Yeah, so just to add on here, Bhavesh, because we have many hooks now. We are not operating only on the interest rate or better interest rate in terms of offering, right? We have many other things to offer also. So I'm seeing that bank is getting much traction now. We are getting more deals. We are getting more, I would say, customer attention also, right? So in that sense, we are getting more deals so that we can choose that which one to take, which one not to take, right? So overall, of course, the rate is very competitive. Market is very competitive, but we are sailing through.
Wonderful, sir. All the best.
Thank you, Bhavesh.
Thank you. The next question is from the line of Renish Haresbhai Bua from ICICI Securities. Please go ahead.
Yeah, hi, sir. Sir, just two questions from my side. One on the credit cost side. So now, since given we are scaling some of the new products like credit cost, which sort of impacted the overall credit cost in this quarter, and maybe post merger we have MFI book as well. So historically, we have seen that we've been able to, sail through all the credit cycle with, let's say, average 80 to 90 basis point of credit cost. But now, given we are entering new products, with MFI coming in, what should be the normalized credit cost, for AU going ahead?
Yeah. So Rinesh, good question. So because, you would be seeing that there is an extra provision in this quarter, but I just want to tell everybody there that ex credit card, our credit cost is around 55 basis point, around about. So which I believe is a normalized for the secured book, Already, as Mayank commented, that 6-7% credit cost on the credit card is there. So we would like to say that it's a normalized kind of credit cost on credit card. Barring, these two products, if you want to say me about the microfinance, we already commented that we want to really even out that whole provision by providing at least 3% credit cost every year. This year's, credit cost on microfinance book is very low, but as soon as we get that book merged with us, we really want to provide the even out kind of credit cost, which is roughly more or less 3%. So I think we would give you a better guidance by next April once we get entire thing in place. But I would say you should assume that, the normal AU book should give you this kind of credit cost, which is 0.5, 0.6 range, and maybe 6-7% range of credit cost of my credit card, and of course 3% on microfinance book. So I won't say that we are surprising it, because we were coming out from the COVID time. It was a very good time for good 2 years post-COVID. So now things are evening out. So I think we should believe in this kind of credit cost as we move forward.
One point,
yeah.
credit card. Renish, just one point on the credit card for benefit of everyone. While we earlier also we mentioned about 6.5, and going in lines of the industry. I think another thing we need to also keep in mind is the industry also sees a decent amount of recovery on the written off book, because credit card typically has a very stringent writing off policy. Like we provide 100% on 120 DPD and write it off on 180 DPD, right? However, the book is still building up. So while we have started writing off from previous quarter, in a decent numbers, it's still not built up to a stage where we can start seeing recovery in a meaningful manner. So I think as Bhavish Bhai also asked earlier, as we move to a more normalized setup, probably in a couple of years from now, while there will be a 6.5, 7% kind of credit cost, which is there as per the industry, there will also be recovery which will start coming up, and probably the net credit cost would also follow what is there in the industry. Just to put that point.
Got it. No, so just to get a sense, let's say going ahead, given our focus is the way we want to build the deposit franchise, credit card, of course, will be one of the key product, in overall scheme of things. So naturally, let's say that focus will continue on credit card, and with MFI coming in to meet the overall PSL requirement, we have to also grow the MFI book as well. So going ahead, your secured plus credit card plus MFI, will be a new normal book for us. So, from that perspective, should we, let's say, assume 1% plus credit cost for the entire AU business, or how internally you would like to look at it?
No. So, Anish, as we already commented that our microfinance book won't be more than 10% of our overall loan asset. We don't want to build more unsecured book. It will be another maybe 10% kind of range where we are looking for. So I won't say that because of this initiative there would be an extra provision, because these are also high yield assets. Once microfinance book coming in, they have a NIM of around 10%, right? So that will take care of extra provisioning, right? Credit card, once it gets stabilized, it will have more positive impact on us. So I don't think that it's right to see in one within one eye that the credit cost will go up. The revenue will also go up, right? So I think I'm just saying you that on a secured book also, my entire credit cost is around 0.3, but we provision around 75% of our NPA, right? So that makes us 0.5, 0.6, right? Otherwise, the entire credit cost is very less. So the real credit cost, right? Because it's a provision which hits you, right? So I would say that, we have already guided you on our whole philosophy around how we want to provision it. Let us be by April, we'll be more clear, how we really want to build ourselves for next 3 years around the unsecured piece, credit card piece, or maybe around microfinance piece. Then we'll be able to tell you that, what type of credit cost you should take in your calculation.
Got it, sir. This is very helpful, sir.
But as of now, I would say that this 0.5 and 0.6 is as per what we thought through, right? Yeah.
Got it. So just one clarification on the other interest income part. So, when I look at the total securitized quantum for Q2 and Q3, it is broadly similar at around 2,500 crore plus. But when we look at the income portion, this quarter's income is significantly higher at 180 odd crore versus 75 crore odd. So what am I missing here? I mean, is there is some NIM expansion significantly on the securitized book, or how is it?
Yes, Vimal this side. So as mentioned on slide number 19, our overall securitization book has been increased.
Sorry, sir, I'm not able to hear you, sir.
Sorry to interrupt, sir. You're sounding a bit distant from the mic.
Is it found now?
Better, sir.
Yes.
So as mentioned on slide number 19, our overall securitization book has been increasing, and we have securitized around 5,700 crore in last 2 quarters. The income on securitization book was getting recognized with a lag of M+1 basis as per the underlying legal structure of the SBV. However, the interest expenses was getting booked in the same quarter. So now we have followed the matching principle to recognize both interest expenses and interest income in the same quarter to remove any lag impact.
Okay.
So this, yeah.
Got it.
This is the reason.
Income will sustain at around 2,500 crore. So then this 180 crore odd other income will also sustain, right? I mean, is that the fair assumption?
Depending on how, Renish Prince here, so depending on how exactly the securitization book builds out, and it is going to build out as it's part of a funding and diversifying strategy. So you can assume that, depending on how we go ahead in future quarters, because it's not only about securitization in that month, the previous book is also building up, right? So now our securitization book is about 8,500 crores. So there is a larger income recognition that's coming in through that.
Got it. Okay. Okay. Thank you and best of luck, sir.
Thanks, Renish. Thank you.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. So the first question is on...
Sorry to interrupt, Mr. Shah. May we request you to use the handset mode because your voice has a bit of an echo.
Yes. So I was just saying with respect to your entire strategy of deposit-led loan growth. So now almost the deposit growth is 31%, but still we are growing at 21 odd percent. And if we look at it right from March till December, in fact, the incremental CD ratio is 80 odd percent. In fact, this quarter, incremental CD ratio was hardly 50 odd percent. So when do we see maybe like we are comfortable and now maybe we should resort to a lesser amount of securitization because deposit growth has been quite strong, yeah?
Kunal, very important question, but, very early days, we have worked strongly on our deposit franchise, and that is why, I'm emphasizing again and again on a 10-year story of AU because these are the foundation years. You never know, how customer react, how market react, how the competition reacts. So our objective is to be really more deeper, more retail, more closer to customer in every sense. We want to make AU as one of their preferred banks, right? And that is why we are doing everything irrespective of, honestly, we don't see much on our cost side because that is needed in these years, right? It's not easy to build a retail franchise in this country, right? So I would say that there is a narrative from the other stakeholders also, the whole regulatory framework also, where we need to calibrate our growth also, right? So based on that, we have to balance ourselves, but we don't want to compromise on our deposit growth, We just want to do it, based on the whole. Of course, we keep track on the cost, but I think, as of now, the kind of competition we are seeing, the kind of India story is being unfolding in next maybe 5-10 years, and we really want to play a very important role in that. So that is why we are too focused on our deposit franchise in every aspect. So of course the CD ratios and all those things are the outcomes, right? But at the general trend, at the general operating time, we don't see this way that our CD ratio is too good, let's not raise deposits, right? Or let's do more assets, right? Because we are a concurrent kind of organization where people come and just deposit the money with you, and we have to accept it, right? So I think it's a very good sign that, we are having this kind of ratio which you just described. And that is the whole secret, right? That is the whole success, right? In my opinion, where we've been preferred by customers as now their banker, right? So, Kunal, I think little bit here and there, but I think we are absolutely on track, and we are managing it. Of course, we will not securitize just for the need of securitization. It's other factor also which works, to manage that securitization. And so that's the whole story.
Yeah. No, so not agree completely on the deposit side. Yeah, absolutely. It's a great growth. The only thing was, does it now provide a cushion in terms of securitizing relatively low compared to what we had seen over past 2-3 quarters? Given that we are at 20% loan growth, would we start following that stance?
I just want to interrupt here. By the March end, you will see this growth in the range of 26-27%. Because there was some base effect because of December 22. But you will see our growth on asset on book will be around 26-27% by end of this March.
Okay, perfect. And secondly, maybe the overall yields are still down 10 odd basis points. We have been talking about incremental yields. The mix shift is clearly happening on the AUM side. But still not entirely getting reflected, and we are saying that given the fixed rate, we should be positively poised. But somehow I think this 38 bits incremental yield completely getting offset by the mix change plus 20 bits kind of a decline. So if we exclude this entire securitization income, would there have been the pressure on the margins to the extent of 30 odd basis points during the quarter? And then how comfortable we would be with, maybe you have lowered the guidance and said like we will be at the lower end of 5.5 for the full year, and we are at 5.6 for the first 9 months. Does that suggest that we'll settle much lower getting into Q4?
So of course, if you add on maths, the data which you are describing will be there. But we are running a bank, right? So there are many levers which support us. There are many challenges which makes us, difficult on our math side. So we are balancing it out, and I'm happy to say that, we're still in this tough time, because the kind of market we are in as of now, it's tough to actually incrementally build a better rates. We are pushing our vehicle team, and they've already done, maybe around 40 basis point in incrementally they are doing better yields, MBL business does not allow space because we are already around 14.75 to 15% kind of rate. That doesn't allow, the commercial banking space still is more on floating, than a fixed. Housing book does not allow you to give much space. We are around 11.25 there. And of course, 11.6. And then of course, the personal loan space, we are around 18%. So already we are at the rates which makes us comfortable, Beyond these rates, we don't want to compromise on the asset quality. And we are growing at 25-26% in our asset also, right? So I think we have to be a little patient here, because this is a tough time, and with this kind of interest rate scenario, we are just balancing it out through various means, and showing you the best kind of decision making to make your balance sheet very stronger, right? So I think there are a lot many if and buts, but I believe that at our end, we are putting our best foot forward to balance it out.
And
Sure. Thanks and all the best. Yeah.
sorry, could I just one last point? In NIM, in any case, when we had guided for the full year, I mean, it was guided for the full year, right? The quarter-on-quarter, because we knew that because of securitization, there are impacts. You know, sometimes there is a lag recognition of the income because of the underlying SPV structure and the legal documentation. And that is why when we guided for the full year. And it was assumed that for the full year, securitization income would be part of that, because again, that interest income or the net interest income on securitized book is added to the entire NIM calculations. So honestly, while the cost of funds have gone, the way that it has gone, whatever we had guided for NIM, we are very much in that range, irrespective of the cost increase on the deposit side, right, or the cost of fund side.
True.
And it would have been the same case, right?
Yeah. Got it. Okay. Yeah. Thanks and all.
Thank you. Thanks, Kunal.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, thank you for the opportunity. So, just looking at the credit card slide page on slide 44, and just matching it up with the kind of credit cost that's been discussed in previous questions, this just seems out of whack. 75% issuance to new to bank customers. That's like way high even on a global parameter. Even the closest competition which does new to bank would be around 50%. And the average limit per card is around 1.74 lakhs, which would be easily around 50 to 60% more than the industry average. Basis that the kind of credit cost that we are speaking of at around 5 or 6% looks absolutely benign. So, what's the case here? We do not have a risk management team at all in credit cards. What are we doing here in credit cards? This looks absolutely outrageous.
Mayank, you want to add on something?
Yeah, Shubhra. Shubhra, so
also, if you can speak about the cost of acquisition per card. That's all.
Yes, Shubhra, I'll answer all your questions. So, I'll take the first question on the limit side. So, Shubhra, on the limit side, if you see, you must be comparing this limit with the average limit of the industry, whereas the industry portfolio has built in over a year, which is last 5, 6, 7 years, the cards are moving there. We have issued new cards to the customer. So if you see and compare with the new cards issued in last 2, 3 years, you will see us much more closer with the industry. This is the first. The second is on the 75% issuance to the NTB customers overall. So more or less in the industry, the cards around 60 to 70% cards are issued to the ETB customers, but that is the phenomena of the top few issuers. Rest of the issuers like our close competitors, they are also issuing cards to the new customers, though the percentage varies from bank to bank. And on the last question on cost of acquisition. So cost of acquisition depends upon the NTB versus ETB and the channel from which you are acquiring the customers. So our acquisition, you see, we have all sort of multi-channel acquisition, which gives us some space to lower our cost of acquisition. And and it also depends as how much we will scale and from which channel we want to scale. So we build the multi-channel distribution, so we can scale it as per the cost of acquisition we will think of, or desired cost of acquisition we want to build the business.
And what's the blended dollar value of ETB versus NTB? A blended number would be helpful.
It is close to 2,000 rupees.
This is ETB?
Both, blended.
No. What is ETB and NTB blended?
ETB is existing to bank customers. We already have the acquisition of customer available with us. We just give them the card basis their already relationship with us. NTB is new to bank customers.
Okay, I wanted them individually. That's fine. I'll probably come back in the queue. That's fine.
Okay.
Yeah, thank you.
Thank you. The next question is from the line of Manish Shukla from Axis Capital. Please go ahead.
Yeah, good evening and thank you for the opportunity. Just sticking to card for once, if I look at the segmental yield, the differential between your home loan yield and credit card yield is only 40 basis points. capital allocation, capital requirement rather will be probably 3x. And yet on a YOY basis, if I compare both the books have ballpark grown about 1,600 crores. I'm just thinking that from a return on capital perspective, how do you are thinking of card business? Where do you think you need to take a call whether it makes sense or it doesn't make sense? Because at 12%, you probably will be on the lower side as far as credit card yields are concerned.
So, Manish, hi, this is Prince here. Now, of course, there is a large fee component in the entire credit card business, right? So while home loan only has typically a NII business with some processing fee, credit card has a equally strong fee business as is already reflective in our other income that you can see. However, we do take your point, and I think Mayank will add his views on that our overall yields, Mayank, please go ahead.
I'm sorry, but just 2 points point there that, I appreciate the higher fees, but the credit cost delta, as we are saying, is also significant, and I'm sure OPEX delta is quite high. So I'm not sure if fees is negating the OPEX and credit cost delta between home loans and credit cards.
So Manish, I'll add to what Prince said and make it more clear, try to make it more clear for you. So when we say 12% in credit card is a business which also builds a term books in it to get yields and let the customer stick with us and make a interest earning book for us. So we are quite new to this business as of now, and we are from last 1 year, if you see, we have built our term book from almost 8-9% to 17% this year, and we will close it around 20% in this financial year. And this, if you see with the larger issuers, the term book goes beyond 30%. So your interest earning book gives you a larger portion on the overall funds or the ENR which you have deployed in the market. So over a period of time, you'll see this is also improving a lot as our term book will start building towards 30% sort of.
Sorry to harp you, man, but during the tenor in which you are talking, where term book has gone up, yield on the book has actually gone down at a time when interest rates are high. So even that math doesn't hold up, right? If you look at YOY yields, the yields are down on credit card book.
Yeah, Manish. So there is also one regulation which has come over last 1 year, which states that you cannot charge interest on interest. So that has come in credit cards in the past years, which has reduced the yields.
Will you be able to quantify that, please?
So I'm saying there is a regulation.
Manish,
the impact of the regulation
side, Manish.
Yeah. Okay.
So Manish, I'm hearing your view and the other participant also, but you have to give us some time to really showcase our whole purpose around credit card business. I think we have done well enough, to create that buzz around the franchise. So there are other benefits also. And of course, what Mayank is just explaining that there are some regulation change and this industry is being watched by, everybody from regulator to other things, you know about it. So, but I'm pretty sure that, we are absolutely on track in terms of our guidance. And more and more, I think you are not aware, so you will be asking too many questions around credit card business because it's still a very small business for us. But by next call, you will find our more strategy in place that how we want to build and why we want to build and by what time we'll get a BEP.
Sure, sir. One last question. On cost to income, you suggested that FY25 might be similar to current levels. So on a standalone AU bank, excluding the merger, when do the cost synergies start kicking in and we go to less than 60%?
Sorry, Manish, can you repeat your question?
Cost to income. Your commentary suggested that FY25 cost to income will probably closer to where we are right now. When does the standalone bank cost to income?
Manish, I understand your question now. So I would say that is why I'm saying you that if you go back in the history of Indian banking, it's not easy to build bank. It requires some patience. It requires some more detail out of every aspect. That is why we are saying that first 10 years is the foundational years for AU's journey. We have done everything, in terms of building ourselves to this level. It's not easy to build 80,000 crore deposits. It's not easy to build 1 lakh crore balance sheet in first 7 years. And with this kind of track record, so idea is to really go more and more in terms of holistic approach, where you build a bank which being likable by the customer, right? Customer should like you, because if customer doesn't like you, or customer doesn't have visibility of AU, then they won't transact with you, they won't bank with you, and then there won't be anything, right? So our entire piece, whether our initiative around digital, initiative around credit card, QR code, even the AD1 license, it requires a lot of investment, time, effort, and everything. But I think everything is being done with lot much sincerity, lot much detail out, so that we are on the right path. So I think you have to give us another maybe 3 years to really come out with any kind of specific, leverage expectation, right? Because the inflation is there, the competition is there, that lot many new things are coming up every day, every night, so we need to responding to those facts, right? So that is why, I'm consistently saying you that it's a 10-year journey. First 10 years are very foundational years, and people need to support us. And we are doing, I think we are doing everything right in that context, If you really see, barring some maths here and there, we are absolutely on track.
Sure, sir. Understood. Thank you for the opportunity.
Thank you. The next question is from the line of Param Subramanian from Nomura. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is on the interest income on securitization. So if I understood it correctly, you have booked both last quarter's interest income from securitization as well as this quarter's, both in this quarter, right? That understanding is correct.
Yes. So what last quarter would have got billed, so generally it happens with a lag of 1 month, as we said. This is the underlying structure of MM plus 1, so you're right.
Okay. That part is clear.
Also the 1 month. Not for the...
Yeah, so last quarter it was not recognized. It pushed into Q3. And this quarter securitization has also been recognized in this quarter, right?
Absolutely.
Okay. Fair enough. And my second question is, again, coming back to the credit card portfolio. So if I understood correctly, sir, based on the disclosure you've made, the credit card provisioning in this quarter is about 50 crores, there or thereabouts?
So provisioning plus write-off all put together would be about 45 crores, 43 to 45 crores.
43 to 45 crores. Prince, so that 43 to 45 crores is about, 180 crores annualized. If we go back to last year, the credit card book, the base of the credit card book was about 1,000 crores last year. That suggests a pretty high credit cost on the credit card book, right? Of course, on a moving base that has grown like 2.5 times over the last year, the credit cost looks lower. But if you look at it from a base adjusted book, it looks like it's 17-18%. So isn't that very high compared to our comfort levels?
Hang on. Param, just hold on. See, I think we have been talking about credit cards a lot, right? Just for everyone's benefit. We have very clearly articulated that credit card is a business, and everyone knows it, including yourselves, that credit card as a business on a steady state basis, even for the larger peers who have been doing this business for multiple decades, have a top line credit cost of anywhere around 6 to 7%, and then there is a recovery angle of 1.5%. So it's a business which is known to have a 5% kind of credit cost and a 4 to 5% kind of ROA. Now, unfortunately for us, we are too young in this entire business. A credit card book's actual colors will start coming in once you build up a 18 to 20 lakh kind of card base, right? Right now, all we are doing is just adding cards, and that's where the limit comes into play. That's where the suppressed yield comes into play, because ultimately you're calculating, to answer earlier question, you are calculating your yield on the outstanding book. The outstanding book is growing much, much faster because they're issuing newer cards. Last year, I started my card base at about 5 lakhs. Before that, I was 1.7 lakhs. I have already reached about 8.5 lakh cards today, right? So what is happening is we are in a built-out period. Also, the fact that for the first 2 years, if you go back and see our credit card costs, the credit cost, it wasn't that high because the book was still being built out. Now that we have got some seasoning, the cards that probably would have sourced about 6 months to 9 months back, some amount of credit cost has started coming in. However, there's no recovery in it. So just allow us some time, and which is what Sanjay ji articulated as well as Mayank articulated on the call, that this book will need to be built out, and once it's built out, it is not going to be any different than any other player in the industry. At least we don't have any reasons to believe so far, basis whatever numbers we have seen internally. Right? So I would just request, allow us some time to build this book.
Fair enough, Prince. But we've grown this book like 20% quarter on quarter. Are we like still comfortable growing it at this pace, or should we, as investors, be looking at a moderation in the pace going ahead? As this pace, as you pointed out, the book is seasoning and the credit costs are catching up now.
No, fair question. And in fact, this question was asked to us when the entire circular also came up around unsecured lending. Please understand, and I mean, through you, I want to, send this message or request everyone to understand that my credit card business is a liability business. It is not an asset business. I don't really have a choice. The reason why we are building a credit card, the reason why I'm building a QR code, the reason why I'm building a personal loan, the reason why I'm building a wealth solution is to support my liability franchise. Right? The earlier question that why NTB is higher. Again, the NTB is higher because I'm using this credit card as a hook to acquire a urban and metro customer like yourself to come and join the bank as a customer and then try and cross-sell you as a liability product, right? Similarly to the liability customers who are joining in from Mumbai, Delhi, Bangalore, I can't really offer you a car loan at 8.5% today because my cost of funds don't allow that, right? But I do need you as a customer, right? All the HNI customers. So what is the product that I can sell you? I need to sell you a credit card. I need to sell you a personal loan. And that is why, please understand, these businesses are not being built from an asset perspective as currently. And hence, I don't really have a choice in terms of the pace at which they're getting built up. If I want to build my liability franchise, then I need to offer these products. And accordingly, the growth rate will be more determined by liabilities than my asset strategy. On asset strategy, I'm very, very clear that it's a secured asset book that I'm driving, which has a credit cost of anywhere around 50 to 60 basis points. And that has come down. It used to be about 1% point or 90 to 100 basis points. But as we have de-risked the book, as the commercial book has got built up, as the home loan book has got built up, the credit profile has become better and better. And hence, we are now getting the benefit of that credit cost, right? So, I mean, in summary, I think some of these businesses, we don't really have a choice if I really want to build a franchise. And that's all we are saying again and again, that it takes 10 years to build a bank. Give us time till 2027, have a slightly long-term view, because if you really want to build a retail franchise in India, you will need to do everything that is needed to be done to ensure that you are able to attract the customer, or at least you make yourself in the first 3 banks or in any customer's mindset. I need to reach there that if a customer wants to open a bank account, he should be in his consideration set. I'm sorry to get that long answer, but the idea was to just put a context to the whole thing.
Yeah, very clear, Prince. Thanks. So in a way, we should be looking at, credit card as a sort of customer acquisition cost, if you will. That is, my takeaway. But quickly, yeah. So, but just quickly, in the past, you've highlighted that, FY25, we should see break even of the credit card business. Now, in the light of, the previous participants also mentioned that the yield is moderating and now we're seeing credit costs inch up. Do you want to revisit that or, on the credit card business specifically? Yeah, that's it from me.
So Param, I think we'll be more specific in our next call. But if you ask me as of now, I will hold on to my statement that we might want to break even next year only by last quarter.
Yeah, we had said end of last quarter, 1 or 2 quarters here and there, but broadly we are on track.
Broadly we are on track. Yeah.
So, Param,
Perfect. Thanks a lot, sir. All the best. Thank you so much.
Thank you. The next question is from the line of Madhu Chandade from MC Pro. Please go ahead.
Hi. Good evening. I have a
sorry to interrupt. Ma'am, may we request you to use the handset mode?
Yeah. Hi. Yeah. Hello. Yeah. Am I audible now?
Better now, ma'am.
Yeah, hi. My question is slightly long term. As you rightly alluded to, the build-up phase of the bank, and we are in the seventh year. So, given that there's a build-up phase, given that there's a slight change in your strategy now in favor of the high-yielding book through the acquisition of this small finance bank, which is predominantly into unsecured. Given this entire context, how should we look at ROA trajectory in the next 3 years for the bank? Hello?
Thanks, Madhu. And again, yeah, hi, Madhu. And again, a long-term question where probably it involves merger, as you rightly said. And there'll be dynamics around that in terms of how much we want to grow our MFI book, what kind of credit cost. We need to understand that book much better. So that's where we are again and again saying that allow us probably April quarter or this quarter for us to come back with a more clearer strategy, because by the time, assuming regulatory approvals come through, we'll have a much better clarity on the merger and the numbers around that. But having said that, look at our past trajectory. I think in the last 5 or 6 years, we have been doing all these investments, right? And we have been going through external shocks. So we converted ourselves in a bank in 2017. We have been building out the entire franchise. Some 5,000 people went ahead to now 29,000 people. And we got tested by pandemic and everything else, which required us to put more liquidity, more provisions. But still, we have kind of delivered a 1.6, 1.7% kind of ROA across on an average basis, right? So I don't really think that should materially derail, right? But yes, allow us some more time, and probably because merger is a significant event, which can have positive impact, definitely, in our view. So give us some time and let us come back to you.
But you would have thought through this before embarking on this step, right? So if you could share some of those.
So Sanjay this side. So you're absolutely right, Madhu, because, sometimes we don't want to be very specific on our numbers, but I would say that, as you know, that we have already crossed 1 lakh crore balance sheet. If this mergers go through, then, we'll be around 1.25 lakh crore by March. And, if even we grow by 25% every year, we are doubling our balance sheet in 3 years. So we know where we are going, but there are not many variables in place, right? What happened, how the interest rate cycle will be there in next 3 years. No one knows, right? We know that our credit cost won't be surprise anybody, because that's our forte, that's our expertise, and I already commented on our overall credit costs on different book, we know how well we will distribute it across India. We know that in our credit card business, QR code business, personal loan, all this business, wealth business will eventually get profitable, right, in next 3 years. So there are so many things. But we don't want to comment, any specific, the ROA guidance or, ROE guidance, because our track record itself is so strong that, we are around 1.7, 1.8 in last 6, 7 years. We already delivered you around 14 or maybe 15% ROE in last 7 years. So that's the strong indication that there are better days ahead, because there are not much challenges now left, except interest rate cycle, right? So I would say that, give us some more time in terms of specific guidance, because that guidance requires much calculation around so many variables, because if merger happens, this will happen, otherwise it will be like this. Or if what are our perspective on interest rate, So that is why we are looking for some more guidance, and that is why we are saying that if we are able to pull through in the next 3 years this kind of data, this kind of product, this kind of size and scale, which haven't been done by any bank in the past, in my opinion, in the first 10 years, and being an SFB, so well diversified, in terms of everything, right? So I think that is the way we want to push ourselves, that, there would be a case, there would be a quarter where some data here and there for some time, but in the long term, AU remains absolutely on track, and we want to become one of the best retail franchise for this country.
Thank you very much, and all the best.
Thank you. The next question is from the line of Arvind R. from Sundaram Alternates. Please go ahead.
Thank you so much for the opportunity. So, I would like to understand, you have given operating expense breakup this time, on investments that are made in credit card, QR, and video banking. I would just like to understand, could we, look for the similar run rate, whatever we have in this 9 months of FY24 into next year also? Do you see, a slightly higher, run rate required in the next year? That is my first question. And in slippages, if I take as a ratio, it has inched up a bit. Is it only because of credit cost, or any other portfolio is also, contributing to it? That is my second question. And ROA is at 1.5% this quarter. But what do you think could be the levers to improve in the subsequent quarters? Thank you.
So, so second question was on credit cost.
The slippages, right?
Slippages.
The slippages, yes.
Pranav, sorry, Arvind. As far as the slippages is concerned and the credit cost is concerned, I think Sanjay ji alluded in his speech that typically, what happens is in a festival quarter, generally your self-employed customers and merchants prefer to, use the money cash in the business, and which happens every year, honestly. And after that, generally you have a good recovery coming in because the festive season is good. Generally, you have good cash flows. The only challenge this time happened was the festive season was immediately followed by the state election in two of our major markets like Rajasthan and MP, right? And these two markets broadly contribute, almost 40 to 50% of my business, especially on wheels and SBL, right? So what happened is during that election period, there's a model code of conduct which is there, and which kind of hampers the entire security enforcement or a collateral enforcement process. And to that extent, what you would see is the slippages hasn't really grown, right? From 345, the slippages have gone to about 349, it has gone to about 403 crores. But more importantly, the recovery has not really happened the way it is expected to happen in Q3. And accordingly, there was reductions as well, did not happen in the same way. And to that extent, the existing NPAs buckets moved and we had to provide because we have a very conservative provisioning policy even on a secured book. Like on a 90 DPD, we provide 25%, but 180 DPD, we provide 50%, right? So to that extent, I think it's more of a one-off in this particular quarter, especially for a Q3. See, Q1, Q2, we generally see this phenomena. Q3, generally, there is a pullback. So I would say this is a more of a one-off, and Q4 hopefully should be much, much better as we get a full quarter to, do the credit recovery. Right? Sorry, I missed your first question.
Sir, I wanted to understand, the run rate, a similar run rate can we expect for investments in credit cards and QR and video banking, whatever you have provided in the presentation now, in terms of absolute number or in terms of percentage, if you can give some color on that.
Hi, Arvind, Kunal this side.
Hi.
So in terms of the operating expenses on the new investment, as we have already articulated that we will stay invested in the new investments, largely around credit card, QR, video banking. So the expenses which you can see over the slide which you are mentioning, so will remain kind of in these growth range only. I think it's around 55 to 60% of jump in these investment and this cost, and this will remain like this for the next year also. And second point that apart from these expenses, we are, of course, business as usual will go as is. Apart from that, we are focusing more on productivity and efficiency, and we are trying to control our employee cost and other related costs.
Absolutely, which is visible in the ratios also, right? If you see, apart from the new businesses, the other ratios hasn't really gone up very significantly. In fact, has come down or stayed there despite the business growing on a year-on-year basis.
Yes, Yes. So when you mentioned like it would grow up, like you're talking about the growth would be in the similar range you're saying. Growth in this new investment.
Yeah, because we'll need to invest in brands. We'll need to invest. So credit card is upfront cost. The moment you issue 1 lakh credit card, straight away acquisition cost. So those things will continue. We don't really see that changing course.
Sure. And like my final question is on levers which are available. Like since cost of funding is going to be tough for some time, and like yields are also like having a bit of pressure. So I'm just trying to understand where would the levers be to improve ROE.
So which time period you are looking for, Arvind? Which time period of levers? So, like, for us,
looking
we are already
at quarters and quarter to quarter. I was looking at third quarter of FY24.
No, I don't think, because as we are already commenting that we are little looking long term. These are tough times in terms of interest rate cycles. So I won't say that our quarter four would be very different what we have done this quarter. But in the long run, next 3 years, you will see our credit card becoming profitable, our video banking becoming more productive. You'll see our ADML license coming in, giving us other income, like what we are seeing now in insurance income that has been stabilized. After the merger, you'll have a high yield book, that it will allow us a better NIM because of that book. After even we put the even out provision there. So there are not many levers in next 3 years, right? And that need to be counted then a quarter to quarter basis. And our track record shows that what we done, is always given a push to this franchise to the next level. Yeah.
Sure. Thank you so much. Thank you for patiently answering all the questions.
Thank you.
Thank you, Arvind. Thank you.
The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi, team. Good evening. First question is on the investments towards digital initiatives. Within that, the expense towards credit cards, QR, and video banking that has gone up sharply, both YOY and QOQ. Can you just qualitatively detail out which are the main cost heads within this? No numbers, but just what kind of costs go into this?
But Ashlesh, I think we have been disclosing these numbers, every quarter for almost.
No, I'm saying that 170 crore. That 170 crore in this quarter, which went towards credit cards, QR, and video banking. What are the main expenses within this? What kind of costs?
Predominantly credit cards, right? It's predominantly credit cards because, as I said, the moment you issue credit card, one fresh new credit card, you straight away have a upfront impact of whatever acquisition cost that Mayank was saying, at anywhere around 2,000 to 2,500 rupees for credit card is an upfront impact, right?
Okay. So you'd say credit card acquisition would be a big charge within this?
One of the biggest chunks.
Understood. Okay.
Then, of course, last quarter we also did a lot of branding as well.
Understood. Okay. And secondly, can you just remind how we are accounting for the securitized book? Specifically, what part is recognized as interest income and interest expense, and what part is recognized as non-interest income, if any?
So everything is whatever we get in securitization on a net basis because it's off balance sheet, right? So whatever we get on a net basis goes into the interest income line under other interest income under the P&L.
Okay, so there is nothing which goes into non-interest income.
No, absolutely nothing.
Okay, perfect. Thanks.
Barring you might be getting some servicing fee, which is very small, residual.
Understood. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Yeah, thank you, Sagar, and thank you everyone for participating in today's call eagerly, and we look forward to your feedback and views. In case you have any further questions, kindly reach out to the IR team, and we'll be more than happy to respond to your queries. Thank you so much, and have a good Republic Day.
Thank you. Thank you so much.
Thank you. On behalf of AU Small Finance Bank, that concludes this conference. Thank you for joining us. You may now disconnect your lines.